Welcome back to The Explainer. Today, we're diving straight into the invisible forces that are quietly but fundamentally dictating the 2026 housing market. You know, we spend so much time obsessing over interest rates and housing supply, and rightfully so, but there is this massive, hidden macroeconomic shock happening right under our noses. It is completely redefining real estate, and it's coming straight out of your wallet. To really wrap our heads around the sheer scale of this, just look at this number, 9%. Home insurance now eats up a staggering 9% of a typical monthly mortgage payment. I mean, that is the highest share we have ever recorded in history. It's a complete structural shift in the actual cost of owning a home, and it's setting this wild ripple effect across the entire economy. So here's our roadmap for today. First, we'll unpack the home insurance shock. Then, we'll look at stricter rules and higher costs. See how this is redefining housing affordability. Track the impact on home prices, and finally, look ahead at the 2026 market outlook.
Let's jump right into part one, the home insurance shock. Because premiums, they have officially hit a record high.
By the end of 2025, data from Maddox showed that the average premium for a new homeowner's policy reached a record-breaking $1,952. Now, that's up about 8.5% year over year, which sure is actually a bit of a slowdown from that massive 18% jump we saw between 2023 and 2024, but it still leaves premiums at an absolute all-time high. Historically, insurance rates reliably tracked right alongside construction costs and house prices, rising, maybe 4.5% annually. But just look at the sudden aggressive acceleration recently. The lag in insurance assessments has finally, painfully caught up with reality.
And this is building into an even larger consumer squeeze. Insurance premiums are significantly outpacing both general CPI inflation and overall home price appreciation. Consumers are literally getting hit from multiple angles here. It's not just that everything is more expensive, it's that this specific foundational cost of homeownership is skyrocketing so much faster than the underlying asset itself.
Which brings us to Section 2, stricter rules and higher costs. Let's see how these expenses are being passed down.
Look, insurers are dealing with tens of billions in industry losses. And how are they managing that? Well, they're passing the burden directly to homeowners. We saw a 22% jump in average deductibles in 2025 alone. They're essentially forcing homeowners to take on way more of the initial financial hit before a policy even kicks in. And underwriting? It is hyper-focused right now. Take the premium penalty for older roofs. Back in 2022, having a roof that was 11 to 15 years old meant a minor $49 penalty compared to a brand new one. By 2025, that penalty tripled to $155. With total U.S. roof claim costs hitting nearly $31 billion, insurers are scrutinizing absolutely every single shingle. But this triggers a massive wait, what moment? Seriously, what actually happens to homeowners in high-risk states when standard carriers look at these risks, decide they simply can't charge enough to cover potential losses because of state regulations, and just exit the market entirely? Well, enter the E&S, or excess and surplus market. These insurers aren't bound by standard state regulations. They offer critical coverage, yes, but it is much costlier, and it often comes with far fewer consumer protections. In places like California, Florida, and Texas, the E&S market has become a vital lifeline. By December 2025, it accounted for roughly 16% of policies in those states. And get this, that is up from under 2% in just 2023. I mean, that is a staggering structural shift in exactly how Americans are getting insured. Moving to Section 3, redefining housing affordability, because we are entirely rewriting the metrics here. Historically, we've always calculated affordability by looking mostly at principal and interest on a mortgage. But as we've just seen, that doesn't really paint the true picture anymore, does it? To grasp the current reality, we need to look at Moody's new Expanded Affordability Index. This is a far more comprehensive metric because it loops in not just mortgage payments, but property taxes, those skyrocketing insurance premiums we just talked about, and ongoing maintenance. We absolutely must look beyond just principal and interest to see the true financial burden that is crushing today's homebuyers. When you incorporate these real-world taxes and insurance costs, the data tells a brutal story. Median income homebuyers are now spending over 36% of their income on true housing expenses. To put that into perspective, a buyer purchasing a median-priced home today needs to earn 1.35 times the median household income just to maintain a traditional debt ratio. The gap between what housing looks like on paper and what it actually costs to maintain is wider than ever.
All right, Section 4, the impact on home prices. Let's look at how this insurance shock actually hurts demand.
When buyers are stretched this thin, something has to give. Regional insurance disparities are actively suppressing demand and directly altering property values across the entire country. Your geography essentially dictates your financial exposure now. For example, Colorado is facing a literal perfect storm of escalating wildfire exposure, severe convective storms, and rising reconstruction costs. The result? A massive $666 year-over-year premium hike in 2025 alone.
And when we connect those localized premium spikes to housing affordability, a crystal-clear visual correlation emerges. The areas with the highest affordability are now largely clustered in the Midwest. Meanwhile, the lowest affordability regions absolutely plague the West Coast, the Mountain West, and Florida. The Midwest is right now remaining relatively stable against all this coastal volatility.
So to summarize this striking geographic contrast, we have the high-risk coasts and Mountain West, places like Florida, California, and Colorado, facing extreme climate exposure. In some of these markets, regulatory caps on premiums are causing standard insurers to actively flee, which forces buyers into expensive state-backed or E&S markets. Contrast that with the steady value we're finding in the affordable Midwest, where median-income families can still actually afford the true, fully loaded costs associated with a median-priced home.
And here's where it directly hits your home value. We are seeing a compelling negative feedback loop play out. Areas with higher insurance rates are experiencing weaker house price growth. It makes perfect sense, right? As premiums rise, the total cost of homeownership increases, which immediately shrinks the eligible pool of buyers and puts downward pressure on demand and, consequently, prices. In fact, Moody's calculates that a 10-point gain in a region's affordability equals a 2.2 percentage point higher home price appreciation. So insurance costs are literally dictating your equity growth.
Finally, Section 5, the 2026 Market Outlook. Let's talk about the future of housing. Now, insurers and consumers alike are not just sitting still. The market is rapidly adapting with proactive strategies and artificial intelligence. But first, you kind of have to know what insurers are actually afraid of right now, and it might surprise you. Actually, scratch that, it will definitely surprise you. It's not necessarily hurricanes. Severe convection storms, we're talking massive thunderstorms, hail, and tornadoes in the Midwest and Southeast, caused $42 billion in insured losses by late 2025. They have completely surpassed hurricanes and coastal flooding as the insurance industry's biggest, most expensive, and most immediate worry.
To combat these escalating risks, 2026 is seeing some wild tech integrations. Carriers are using drone and satellite imagery for hyper-accurate roof inspections before they even write a policy. Consumers are leveraging large language models to navigate and shop for these incredibly complex policies. And insurers? They're heavily investing in proactive risk management. Programs like Nationwide's Ting, which monitors your home's electrical systems to prevent fires, or SageSure's Roof Shingle Reinforcement Initiative. It shows how small, upfront tech investments can significantly reduce the severity of future claims.
Which leaves us with this final, profound question. As insurance costs permanently reshape property values and traditional affordability, will homeownership become a luxury only the climate-shielded can afford? We've seen how hidden insurance costs dictate home prices and force buyers to rethink location entirely. Thank you so much for joining me on this explainer. Keep your eyes on these macro trends, folks, because they are literally writing the future of real estate right now.